Kenneth Polcari joining us, Chief Market Strategist at SlateStone Wealth. Kenneth, very good morning to you from where we are. Thank you so much for speaking with us today. Do you see more good news on the offing, or do you think the big ones are done? The US-UK deal in the bag, US-China looks like it's easing off. What's going to follow is more of the same?
So, listen, I don't think either one of those deals are done. I think while the outline is in place, I think there's much more conversation to have. So I think that will continue to be an ongoing conversation. Scott Bessent, in fact, said it today that he plans on having further conversations in a couple of weeks to get further into these conversations. So, yes, I think that's still to come. And then I think there are other deals that are coming. You know, the White House tells us that there's at least 24 to 28 more countries that are lining up ready to sign on the dotted line. We don't know who they are yet. They haven't been made public, but they're all supposedly ready to go. So that will continue to create a very positive atmosphere. But today's action was very dramatic. I think it was a huge sigh of relief because the way we went into it on Friday was that the discussions over the weekend were just trying to de-escalate, trying to, cool the tension. Nobody really expected that they were going to come and announce a deal on Sunday night or Monday morning, which is what they did, which is what caused this very, very dramatic, very welcome. Trust me, I love the fact that stocks are up as much as they were. But again, to your point, like you said, I think there was a massive, boomerang, and it's going to kind of readjust a little bit. But I do think the worst is over for the markets.
Okay, the worst is over. So therefore, Kenneth, one can argue that the theme song might just have changed to a song that George Harrison wrote. Here Comes the Sun, I guess. But from a monetary policy standpoint, would you say that there's going to be a prolonged pause? Because most people are now penciling that in fact, that July cut might not come through because the Fed seems to be more cautious than it was before. And you might just see it happen in December.
Listen, I'm in the camp that we're not getting any rate cuts this year. I don't think we need it. The robust, the hard macro data does not suggest weakness at all. The soft data, which is like the sentiment data, which is really surveys of opinion, that might be a little bit weaker, but you also have to take into account who are they surveying, right? And so I think you have to be very careful when you think about what the soft data is saying, while the hard data remains strong. I think rates at 4.25% are not usurious, nor do I see them restrictive, because if they were really restrictive, then the robustness that we see in the economic data wouldn't be nearly as strong as it is. So I'm in the camp that we get no rate cut. Now, there's a whole bunch of people here that are stamping their feet, screaming and yelling that they need a rate cut, they need a rate cut. And a lot of these people are people that came into this industry in 2007, 2008, when they saw rates at zero for 15 years, and they think that's normal. So they think 4.25 rates are usurious. How could anybody live with 4.25 rates? And so they're stamping their feet. I think the Fed should stand pat until there is a clearer picture on what all this trade stuff is going to do. And look, if the trade agreements happen, and we avoid a recession and the economy remains robust, there's no reason to cut rates.
Yep, 4.45% 10-year plus inflation data today might also be not great. So point well taken. The question, though, Kenneth, going ahead would be that the overarching beliefs in the months of February and March was that the dollar keeps on declining, and at the margin, money keeps moving towards emerging markets. Now, with this trade deal, China presumably becomes more investable again. What's your sense? Do you reckon that emerging markets and China become at the forefront of investors' minds?
So listen, I have to be honest with you. I don't invest in China at all because I don't trust the Chinese government. I don't trust the thing that they say. So my only exposure to China are through names like Apple. Right? It's an American company that has exposure to China. That's it. I don't invest in Chinese ADRs. I don't invest in China because I could wake up tomorrow morning and then the whole world is different because Xi Jinping decides to change the rules. I'm not interested. Now, that doesn't mean that I'm not interested in other emerging market economies. I would be, or I am, and I'm always very interested to kind of watch to see how they're doing. Now, the emerging market economies are actually doing okay. The EEM, which is the ETF that we follow here, is actually, I'm just looking at it now, because it was up again today. It's up nearly 10% this year. So there is opportunity in emerging market countries, but those are countries other than China, in my view.
Okay. So from that perspective then, how do you anticipate that flows will move? Because of late, barring what we saw overnight, Kenneth, the mood has been to reduce weight on US, and that's going to take some time to unwind. It's built up quite dramatically. Where does that money go?
Listen, I think that argument, that narrative about sell the US and go to Europe and go to emerging markets and all that stuff, lit up when we had Liberation Day here on April 4th, when the market started to completely fall apart, when nobody expected the trade deals to be chaotic and to create nothing but chaos in the US. In fact, that does not appear to be happening. Like we said, you got to deal with the UK. You got to deal with China. You've got 25 other supposed deals that are lined up, ready to go. So if these trade agreements are rewritten, because look, I have no problem with rewriting trade agreements that are decades old. The world has changed, so they need to be revisited. I get no problem with that as long as it's all fair. If that's the case, then I think the money that people were nervous about, I think the money kind of moves back to the US. I think there's opportunity, quite honestly, in Europe. And I do think there's opportunity, like I said, in some emerging market countries. India, one place, certainly not, for me anyway, not China.